Okay students, I'm back and this is the third video for chapter 3. We're going to be talking about depreciation. Now for accounting purposes we're not going to talk about value. Okay, you know that a car or a house might depreciate or appreciate in value over a period of time, and that is a correct definition of depreciation or appreciation, but it's not the definition we use in accounting because we're looking at cost and what we're going to do with the cost of that asset. So for accounting purposes, depreciation is the systematic allocation of the cost of the asset over its estimated useful life. How useful is it going to be to us? Or another way we could say it is depreciation is the decrease in the usefulness of the asset. So it has to do with usefulness rather than market value. Okay? And it is a system of allocation rather than valuation. Just keep that in mind as we go forward. All right, let me give you an example. Let's say we purchase an automobile for $30,000, and I don't know how long you keep a car. I keep it for 10, 15 years myself, but you might trade your car in every 3 to 5 years, and a business probably would not keep an automobile longer than 5 years, and then they would sell it. And there is a value, even after our estimated useful life is over, there usually is a value of an asset and we can sell it to someone else. We call that the residual value, and we do take that into consideration when we actually calculate the depreciation. You'll go into that more in chapter 10 if you continue in accounting. But right now we're going to keep it simple, so we're just going to ignore the residual value and take the total cost. Let's say the estimated useful life, that's a way to abbreviate that, estimated useful life, how long is the asset going to be useful to us? Let's say that's 5 years. So the annual depreciation, keeping it simple, using straight line depreciation, would be 30,000 divided by 5, or $6,000 a year. However, if we wanted to get the monthly depreciation, since we'll probably be making monthly entries, that would be 30,000 divided by how many months? 6 times 12. Or we could just simply say, take the 6,000 and divide that by 12. Okay, 6,000 divided by 12 should be, what, about $500 a month? Okay, so we're going to take $500 a month of the cost of the asset and put it into an account which we're going to call accumulated depreciation. Now, let's put up our accounts. Here's our T account for the auto. Okay. And here's our T account for the accumulated depreciation. Okay? Now, when we purchased that automobile, we might have financed it, we might have paid cash, but let's keep it simple here and say we paid cash. So our entry would have been a debit to automobile or automobiles, which is an asset, and a credit to either cash or notes payable, maybe a combination of both of them, but we're just going to say maybe cash because we're going to keep it simple. So that would have been the original entry. Again, that's not the adjusting entry. Okay, what we're going to do is take that $30,000 and allocate it over the life of the asset. So really this adjusting entry is a type of prepaid expense, just like supplies. Remember supplies? We decided how much we'd used, and we took it out of the asset and put it into an expense account. Okay? So that's what we're going to do here, except we're going to do it just a little different. We're not going to actually use the auto. We're going to use the accumulated depreciation now. I'm going to erase some of this here. We've already got these numbers, so I can put up another account, and I can put up the actual journal entry. And that account is going to be depreciation expense, because remember, we're going to charge the cost of the asset that we're allocating for this period to expense. Okay? So let's put up another account called depreciation expense. Okay, now you have to calculate the amount of the expense, but you also have to leave the cost of the asset in the asset account. But let's go ahead and make the entry. We've determined now that $500 is going to be charged to this period. So we know we're going to debit expense to increase it, so that's $500 here. Now the reason I put that accumulated depreciation account up is because that's the entry we're going to use to accumulate the depreciation. We're not going to take it out of the automobile. Not directly, okay? Alright, so our entry then is a debit to depreciation expense and a credit to accumulated depreciation I'm going to abbreviate there, and that was $500. And we're going to ignore that. I should have put that on the end instead of the accumulated depreciation, but we'll ignore that one right now. There is one more thing I want to do with that though. And the entry here then is a debit to depreciation expense in T account form, a credit in accumulated depreciation in T account form, and here is your entry in journal form. Okay? Now that's the adjusted entry. What actually goes on the financial statements is what we call book value. And the book value is simply the difference between the cost minus the accumulated depreciation. Nah, my finger didn't work too well there. Forgot I'm not using chalk. Okay? In this case, our book value, or what ends up in the balance sheet of the financial statements, is $30,000 minus $500. So the book value now is $29,500. Now both the cost and the accumulated depreciation will go on the balance sheet, but you will net them when you add in the asset to the total assets. Also, the automobile and any other asset that you would take depreciation on is called a fixed asset, a long-term asset, a property, plant, and equipment asset, so it would go under that category. Okay? That's all I have for now. If you have any questions, let me know. Thanks.